All right. Good afternoon, everybody. This is Dan Sheridan, and let's talk iron condors. Here's the case study. You ready? Today is November 7th. Beautiful day. And here's what's going on in the market. Let's just lay it out here, and then we'll look at a strategy here. So here's where we're at. We're at about 66.55 in SPX. Say, hey, no big deal. I'm not done yet. So we're down almost 70 points today, right? And again, this is November 7th. Yesterday, we were down 76 points, starting to get the idea, some big moves in SPX. And today, as we speak, we're around 66, as I said, 66, 65, really right now, closer to 66.50. About 8 days ago, 9 days ago, we were at 69.20. So we're down about 270 points or so in the last 8 days. So what are we talking? We're talking about a 4% down move, which the way the market's been moving this year, other than April, that's quite a bit, right? And so for the year, we were up about 20% the last 6 months. Now we're up about 14%, but we're down 4%. VIX in the last 5 or 6 days has gone from 17 to the current level of about 22. All right, so that gives you a scenario, right? VIX has gone from 17 to 22. You say, Dan, is 22 significant? Over the course of 2025, the range has been like 14 on the low side, 14, 15, and the upside 21, 22. That has been your normal range. You had some kind of, UFO type stuff in April, which was outside of the range for 4 or 5 days, and vols were much higher. But this is your normal range of which I would do trading in, 14 to 22. So we're at the upper end of the range, 20. I say, Dan, call yourself a range-bound trader. Are we range-bound right now? We're not exactly, right? I mean, VIX isn't exactly exploding. It's near 22, but still, we've gone down the last 6, 7 days, heavier the last 2 days, right? But Dan, don't you like to sell high volatility? No. Well, let me take that back. I like to sell high volatility, but there's a second part of that sentence. When it looks like the world isn't going to end, right? You want some stability. So some two-way. Otherwise, if you're just selling high volatility for the sake of selling high volatility, when it unwinds, and again, what does that mean? It means when the market goes down, vol will go up. Okay, so you sell high vol, right? Because the market's been going down, and then the market goes up, right? Vol will drop. You'll benefit from that, but you'll lose from the price move. You might make a little bit of break even. So I'd rather do short premium strategies like put credit spreads or iron condors or butterflies when VIX is higher and it stabilizes a little bit. Even if I'm selling a little bit lower volatility, I'd rather have a little bit more range bound, right? That's the definition of range bound, some two-way. So that's the scenario. So we're going into the weekend. And lately, weekends can be a little, especially when you've been down for 6, 7 days, people can get a little nervous about, we're coming into the weekend, and they don't want to necessarily be long coming into the weekend. So sometimes that could keep the pressure on. So if I'm going to do something today, what would I do? Right? Probably do short Vega. We're in the upper end of the range. I'm more of a reversion to the mean, more of a volatility trader. And so I'm going to go even a little bit further out. I'm going to go to December 5, which is 28 days. You say, Dan, why in this case are you considering something like 28 days? Could you go closer? I could. Why are you going 28 days? The answer is because I can take advantage of the higher volatility, but because you're going further out duration, I'm going to have lower negative gamma. What the heck does that mean? It means your deltas are going to go against you a lot quicker. What does that mean? It means I can handle a good 100-point move either way, right? So that's kind of this scenario going on today, November 7th. And now If you've ever taken your kids to Build-A-Bear up in the malls, let's build a bear. So there's two types of iron condors. And again, do I like 0-day iron condors or 10-day iron condors or 15 or 20? Yes. I'm just taking a scenario today, focusing on that to teach iron condors. We can do other stuff with shorter term that would be, I'm looking at them a little bit differently. And again, it's good to have diversification in your trades, some further term, some shorter term. It's that yin and yang that you can have. The further duration can handle a price move better, but you get a little bit less theta. Your shorter term trades give you more theta, but they have more price risk. And here I'm going a little bit further out, almost 30 days, because even though I'm giving up some theta, I'm selling volatility, one of the higher levels of the year, excluding April. So that's kind of the preamble of this thing. So how are you going to build it, Dan? If I wanted, since we've been down, I might start this one a little bit more closer to delta neutral, a little more equidistant, kind of equal room on each side. If I wanted to lean a little bit shorter deltas, have more room on the downside, it would be, I would call it a same delta. Maybe sell a 10 delta, call 10 delta put, 20 delta call, 20 delta put. So let's build one here that I would do in this scenario. All right. So I'm going to look on the put side. I'm in December 5. So we're 28 days out. I'm going to go and I'm going to sell a put. I'm going to sell a 25 delta put. Excuse me. Sell about a 20 delta put. So let's build this here. So there's sell put, 20 delta put. And then in this case, let's just do 10 wide. I mean, if you're a beginner, I'd go 5 wide. If you want to put a little more capital, you could go 20 wide. And so let's go 10 wide. And there we are. That's a put credit spread. Now, could you just do a put credit spread? We've been down for a while, and then if it goes up, leg into an iron condor. You could do that. But today we're just going to start with an iron condor. So we've got the shorts, the put side, 20 delta. And what am I going to do on the upside? What call am I going to sell? I'm going to sell a delta to pick the short strike. I'm going to sell a delta maybe of, let's go 13. All right. And I'll go 10 wide. Presto. Dan, why are you selling a 13 delta? And what's this 20 delta put? What gives here? Well, I want to get the Greeks or the deltas a little bit closer to zero. So how do you do that? You take a higher delta put, lower delta call, maybe 6 or 7 between them. So I sold a 20 delta put, 13 delta call, 10 between them. So I'm setting this up something a little closer to zero. After we've been down 4%, I don't want to start it as short delta. You say, why? Well, we've gone down 400 points. Not that we can't go further. So that's where we're at, right? So that's setting the tone. Now, let's hit the chart. You say, easy for you to say. So we'll bring up the chart, and here we go. And this is the chart. And you could see, even by doing a 20 delta put and a 13 delta call, we're close to zero, but just a tinge short, minus 0.4. Relatively neutral gives me just a tinge more room on the downside, but it looks pretty equidistant. What do you mean it looks equidistant? Here's where we're at in the middle, 66.51 or so. From an eye visual, about the same amount of room each side, maybe a little more one way or the other, but the deltas are a little minus 0.3. If I did a 20 delta put, which I did, and instead of a 13 delta call, a 20 delta call, what would have been the deltas? It would have been like minus 0.8 or minus 0.9. It would just given me more room to the downside. Since we've been down 275 points or so in the last week, I'd like to be closer to flat, minus 0.4, less than a delta short. So in this example, you can see I'm bringing in a credit of $2.80, $2.90. This is live, so it's changing. 290. So if my credit is 290, my risk could be 710. How'd you get that, Dan? The risk. You just take the difference in strikes. This is a 10 wide iron condor. So it's $1,000 less your credit. Even if you round the credit to 3, $1,000 difference in your strikes is 10 wide credit spreads. 1,000 minus your credit, 1,000 minus 300 or so, it'd be about $700. So if I say I want to make 10%, it's not 10% on the credit, it's 10% on the capital you have to put up for the trade. And you can see the max profit will be your credit and a short-long ratio of 1.05. And that just measures how much juice is in the trade. Now, when you look at the graph, and here's the strikes, I'm short the 63.50. The underlying is at 66.50. So I'm short the 63.50 put. That's 300 points out of the money. I have 28 days to go. 300 points out of the money. Let me say that in Spanish and Swahili. 300 points out of the money. And I'm 10 wide. My hedge is 10 points further out of the money. On the upside, I'm selling the 69.70. That's almost 300 points, 280 points out of the money on the upside. So close to equidistance. I have 300 points on the downside between the current price, 66.50, and my short strike, both ways. On the upside, 66, 67, I have 320 points to the upside. On the downside, I've got 300. So close to equidistant. Theta is 7. You say, Dan, isn't that kind of paltry? That's not a lot of positive theta. Well, because you're 28 days out, right? But I'm short Vega. So volatility goes down, theoretically. Every point, theoretically, if each of my 4 options goes down a point, I'd make $27. If volatility dropped 5 points, that'd be about $125. And those are the main Greeks I will focus with for now, except gamma. Gamma says basically 0, right? Now, it's low, right? It's low, 0, and it'll change in a little bit. But when it's a low gamma, -0, -1, -2, what does that mean? It means the deltas don't move that fast against you. It means you can handle a 100-point move, right? On these types of trades, right? Your deltas for a 1% move up or down aren't going to change much. So this is the type of trade that I would consider on a day like today. And we can look at this. Let's just start here. Let's just look at some of these variables so you can get your hands around an iron condor if you haven't done it. Now, again, you say, Dan, what if you had $10,000 and you're going to do iron condors? What might you do? Well, I might put, well, again, experience levels, everything, but you can put 60, 70% in maybe further out iron condors, maybe 3, 4, 5 weeks. And then you could put 20, 30% in shorter term iron condors. Why would you do that? Well, with the shorter term, you could get more theta, but price risk could go against you a little quicker. If you go further out, you get more price protection, but less theta. So I could have a blend of it in there. And so in there, sprinkled in, I'd have some 0-day. I might have some, 15-day. But then I might have more of the capital, maybe 6, depending. It depends on your experience level. Might have a little more in longer term. But if you look at this price move, so I'll just deal with price here for a second. And you could see here we are 28 days to go. And if we move this even, let's go 1 week into the future, which would be we're down to 21 days. You can see a little sunlight is coming out. Sunlight meaning green, green meaning profit, right? And I want you to watch as we go, just focus on the P&L. We're just focusing on that for a second. And you could see, and when we're in the middle, here's a P&L in a week. And again, this is the only a parameter we're moving as price. It says 56 bucks in a week. But you can see as it moves away from the center, especially if you get to the short strike, that'd be a big move. 1 week into a 28-day trade or so, you could be down $242. And if you go to the short strike in a week, it could be down $100. So do you want it to go to the short strike? Yes, not today, right? If we go to the short strike, right, 1 day before expiration, right, or even, hours before, the end of the day, here's near expiration. Absolutely, you want it to go to the short strike, right? But not a week to go. So that's just focusing on price. Now, what if we throw one variable into this? Let's look at price and delta. And delta is the most important Greek in my opinion. Why? Because, all your range-bound trades, you have two risks, price and volatility. Well, price is more important in my opinion, right? That's the big kahuna, right? So if you look at this, the day we start it, right, you can see we're pretty close, minus 0.37. But if we start moving again towards that short strike, we go from minus 0.37 to minus 1.5. And think of delta when you're first starting. I was like, you're short stock. You don't want it to go up. And you could see as we're going up, my deltas are getting bigger and bigger, minus 0.7, minus 1. We keep going minus 1, so that's what resulting in, you can see the P&L. If we go to the short strike the first day, now that would be a huge move, right? Much bigger than the expected move, but you could lose 300 bucks, right, on $700 of capital. So you don't want it to go to the short strike the first day, but that's a very unlikely event. And on the downside, you can see, again, we're starting out minus 0.36. If we go down to the short strike, those short deltas start getting long, right? And that's, in a range-bound trade, you can't have your cake and eat it too. You get short deltas on the way up, long deltas on the way down, and that's going to translate into minus P&L. I lose less on the downside because we started out a little bit short delta, even though I started with a bigger delta from my short put 20 and a smaller delta for my short call for 13, I believe. Let's move on with the Greeks, right? And let's go from delta to theta. And you can see when we start the trade at the beginning, right? We don't have a lot of, if it moves against us, we haven't accumulated a war chest of theta. You can see our theta is 7.2 there, down here. And as we go up towards the short call the first day, our theta goes down from 7 to 3. And towards the short put, it goes down pretty good. You can see that, the numbers. So as you move away from the middle, you're giving up theta. Again, we're starting with a theta of 7.2. If we go, there's 28 days. If we go half the duration, 14 days into the future, our theta grows from 7 to 12, pretty good percentage. And you can see along with that, in a week or in 2 weeks, you can see there's pretty good profit here in the middle here because you're accumulating some decay. But again, in the middle, our theta is 11. As we get to the short strike, your theta will be cut in more than half, right? And your P&L will be cut, right, as you move to the size. How about one more Greek? And you can put them together if you'd like, but let's just start out easy, just one variable at a time. So here's P&L and Vega. And again, we're starting out, we're short 21 Vega. And if you go towards the short strike the first day, right, your Vega goes from minus 22 to almost to zero. And on the upside, it goes from minus 22 almost to zero. Why? And why, when you go to the short strike and the Vega, your short Vega gets much less, you're also losing money. So why is that? Well, because there's less extrinsic value left. When you start out here, you're selling more extrinsic value. By the time you get to the short, let's just say you get to the short call, your puts have kind of got decimated. There's not much left of extrinsic value in your short put, and your short call now is more in the money, right? And so you're going to have less extrinsic value there. Now, I'm sorry. This is 2 weeks into the trade. Let's go back on that. So if you start out on this trade, I'm short 28 Vega, and you could see your Vegas go to zero, right? And you lose money because you get a lot of your extrinsic value, right? And if you go to the put side, your call side is going to go to zero, so no extrinsic value there. Your short puts will go in the money, and then there'll be no extrinsic value. So you're getting hurt there. Now, if we go 2 weeks into the trade or whatever, you can see at least you've gotten some theta there, but still, you see your Vega is decreasing as it moves against you. So these are nice features to play, to understand what you're doing. And you can play different ranges there. It can be narrower so you can see at the beginning, or you can get it a little bit wider. The last thing I want to go over with you is this. Well, what about the whole reason I did this today, right? Why did I do this? I did this because when I put this trade on today, or when I looked at this, we're near 22 VIX, 22 implied volatility. Well, what does that mean? It means there's more extrinsic value, more juice, more premium to sell. But as that volatility starts coming down, you can see the sun is coming out. You're making money. So you want the volatility to decrease. And that's when I'm more apt to go further out on short Vega strategies like butterflies, credit spreads, and iron condors. When the volatility is high with credit spreads and iron condors, you're going to get a little better credit, but you get more room. But again, remember, finish the sentence. I do not want to sell high volatility just because the vol's high. I want to sell it when it's high, and I think there's some stability here, right? In the current environment that I'm talking about, I think there's some stability. VIX isn't going crazy or anything, like going too high in my opinion, but I still would like to see things a little more stable before you would commit more dollars. So hopefully this gave you maybe a little bit of help. I think next time maybe I'll come back and do much shorter term. Iron condors, maybe focus on 0 day. So thanks a lot, everybody. Appreciate it.